Hello.
Hi guys, today we're at the show flat of Nava Grove, and in our last video we shared about the upcoming CCR launches as well as how future OCR plots such as the ones in Bayshore could potentially be launched at a higher price compared to the upcoming CCR plots. If you'd like to see the video, feel free to check out our respective YouTube channels for more.
Yeah, so when we talk about CCR developments, from our conversation with clients, we do know that some of them are still a bit resistant towards entering CCR properties. So today we're going to touch on 3 pointers. Firstly, whether is it risky to enter CCR today, and also the narrowing price gap between CCR versus RCR/OCR. And lastly as well, the difference between how CCR projects today are built versus in the past. Is it risky to enter CCR today? Considering the high percentage of unprofitable transactions of certain CCR projects, it sure worries people when they think about entering such projects.
Yeah,
as we can understand why some people are resistant also.
let's take an example. So if we go back to 2006 or 07, we have this project called Scott Square. Okay, so if you're familiar with Scott Square, this project is very prime location, and at first glance, ticks a lot of checkboxes. Okay, very near the MRT, freehold, and right in prime Orchard. But if we take a closer examination and we see the profits and losses of the development, we see that for everyone who has transacted here, 87% of people have made losses, okay, compared to only 13% that made some small gains.
That's like 9 out of 10 people who entered this property made losses.
Yeah, I think that's pretty discouraging if you're looking to actually buy a project where you thought you had very good potential. So if we take a closer look as well, we see even 3-bedroom owners, okay, they have made losses of up to 1.5 mil over a 9 to 10 year holding period. That's not very encouraging.
Yeah, the annualized loss was around 2 to 3% on average. So imagine being in their shoes. The money that you invest in this property could better be put elsewhere and generating much better returns. Let's say in the span of 9 to 10 years.
Exactly. Yeah. So if we go back again to 06 and 07, when Scott Square was launched, let's say we look at alternatives. Okay, so actually back then, we had this project called Centris. So if you're familiar with Centris, it's actually a place located at Jurong. It's an integrated project right at the MRT. So, on paper, I think if you had a choice to buy between both projects, let's say money wasn't a factor, okay, I think most people will agree that they would want to stay in Scott Square, right? Prime Orchard freehold versus in Jurong, 99-year leasehold project.
Yeah, but Ollie, you see the price gap, right? The time when owners first bought Centris, it was only 500 PSF versus Scott Square was like 4,000. That's like 8 times
almost
more.
8 times already. Yeah. So crazy. I think quite frankly that price gap, okay, 500 versus 4,000 is quite ridiculous for the average Singaporean, right? So I'll say most people or most normal human beings will still go for Centris, right? Okay, unless you're a mega rich profile. I think from this we can also see why people are making losses at Scott Square, because when they buy at $4,000 per square foot 20 years ago, they're already buying higher than today's CCR price point.
Yeah.
Furthermore, in 2006 to 2007, if one had bought Centris instead of Scott Square, instead of losing money, an owner could have made 6% year-on-year gains. For example, this 4-bedroom owner who made 1.6 million over a 17-year holding period.
Yeah, correct, exactly. However, if we look into this current situation, honestly speaking, the price gap between CCR versus RCR or even OCR has narrowed significantly. Yeah, so take for example, 6 years ago in 2019, the price gap between CCR versus RCR was at 72%, CCR versus OCR was 112%. Whereas in today, CCR versus RCR has dropped to 11% in terms of the price gap, and then CCR versus OCR only 25%. So the gap has narrowed a lot. So I think in also our last video, we did discuss on how the launches in RCR, for example, like Ori, already crossed 3,000 PSF. But now we are in a very unique situation whereby for a similar price point or just a little bit of top up, you can even be looking at properties in the core central area.
Yeah, I think recently One Marina Gardens and Aurea in the downtown area they launched, and I think some buyers they even managed to snag units at 2,900, which is actually under the RCR price points like at Ori or AIBT. Yeah, I would say even now, if you were to top up a slight bit. Okay, there are also certain units in even Nasim area where you could potentially also buy a unit.
Yeah, 19 Nasim. So I think given a choice with CCR and RCR at similar price points, would it then be enticing for people to want to enter CCR instead in today's market versus the huge price difference between CCR and RCR or OCR in the past? Yeah.
I think that would be a serious dilemma for buyers now.
So the next thing we're going to talk about is the evolving developer trends. Developers now are changing the way that they are designing the condos, especially nowadays they're more family oriented versus in the past where they are more investment centric.
Yeah.
So let's take two different developments as examples. One is OU Twin Peaks and Martin Modern.
Yeah. So if you're familiar with OU Twin Peaks, location is great. It's right behind Takashimaya. It's just about a 5-minute walk. Okay? And right beside the Prime Orchard Belt as well. OU Twin Peaks was launched in an era where the developer tended to skew the project more towards investors. If we take a close look at the unit mix, for example, out of the 462 units, 268 are actually one-bedroom units. Yeah, if we do the math, that's actually more than half the development having one-bedroom units. Yeah. So while the project itself is very luxurious, I think we also know there are some celebrities staying there, right? The structure of the unit mix tends to make the place more tenant-focused and maybe a bit service apartment-like. Yeah, not very family-oriented. And if we take a deeper look at the floor plan, the 268 one-beders here at 549 square feet, objectively, the layout is quite poor. These one-beders are not even pure one-beders. They are studio units without walls to the master bedroom. Okay, and also being very inefficient with huge balconies and planter boxes. If we see the floor plan, I would say about estimated maybe 40% of the entire floor plan is actually balcony and planter box space, which is quite wasted. But back then, developers could build the project in this way. Now you don't see planter boxes anymore, for example.
So if we compare this with Martin Modern, which was launched later, the unit mix of this project was more well-balanced. Firstly, they do not have any one-bedrooms. So the project starts with 2 bedrooms and there's a very even mix compared with the 3 and 4 bedrooms in the development. So this will tend to cater more to the family and own stay crowd in the resale market.
Yeah, so I think in general, the very investment skewed condo versus the more family skewed condo could be a contributing factor to why, say, OU Twin Peaks suffered major losses compared to Martin Modern, which had pretty decent gains. Yeah, if we take a look at the profitability, we compare the two, Martin Modern has a decent profit trend compared to, say, OU Twin Peaks, where 94% of the owners actually made losses. Yeah, and if we see the profits, we can see even for Martin Modern, some of the 4-bedder owners here can even have up to 1 mil plus in terms of profit gain. Yeah, over just a 4 to 5 year holding period, which is pretty impressive.
Right? Correct. Also with the ABSD ever increasing and now standing at 60% for foreigners, gone were the days where there were more foreigners in the CCR market compared to now. So for example, in 2015, 1/4 of the buyers were made up of foreigners in CCR, whereas last year, foreigners only made up about 10%. So today the CCR market is mainly dominated by Singaporeans and PRs. Hence, there are also more homestayers and also less speculative. Buyers are buying for own stay and not just purely for investment.
Yeah, and I'll say maybe even if the buyers are looking for investment, I'll say now trends are changing also because even our local buyers today, they tend not to say want to buy a small 1-bedroom just for purely rental purposes. They also want to buy bigger unit types with more potential for capital appreciation.
With that, more units and also bigger unit types and also more family-oriented amenities, these developments cater to a wider range of profiles and hence ensures a more stable demand as well, which indirectly translates to better price protection.
In general, we've discussed some good topics here. So in general, I think CCR would be worth considering, especially with the narrow price gap, the evolving developer trends in terms of the way they are designing the condos, and also government rules such as ABSD have also changed the way things are compared to, let's say, 06 and 07, or compared to last time.
So we've come to the end of our video. Today we actually touched on a few pointers as to why CCR could potentially be a good proposition in today's market. So if you like our content, do feel free to like and subscribe to our channels and we'll see you in our next video. Bye-bye.